Have you ever wondered how wealthy families manage their assets? Today, we delve into the world of family trusts. Family trusts, in essence, are financial tools that allow you to pass wealth onto your loved ones in a managed, controlled manner. They act as a separate legal entity holding and managing assets for the benefit of certain individuals, usually family members. They offer a unique blend of control and protection, allowing the settler, that's the person who creates the trust, to dictate the terms under which assets are distributed, while also shielding those assets from potential creditors. In the realm of wealth management and estate planning, family trusts are invaluable. They equip you with the power to protect your assets, control their distribution, and potentially reap significant tax advantages. So now that we have a basic understanding, let us explore the different types of family trusts and understand their unique characteristics. Family trusts come in various forms, each with its unique features. In Canada, two prevalent types are testamentary trusts and inter vivos trusts. Testamentary trusts are created upon the death of an individual as specified in their will. These trusts can provide a layer of protection and control over how the deceased's assets are distributed among beneficiaries. Conversely, inter vivos trusts, also known as living trusts, are set up during the lifetime of an individual. This type of trust allows the settler, the person establishing the trust, to maintain control over their assets while they're still alive and dictate how these assets should be managed after they pass away. Both testamentary and inter vivos trusts serve unique purposes and can be tailored to meet the specific needs and goals of a family. Now that we understand the types of trusts, let's discuss the key roles within a family trust. A family trust is not a one-man show. It involves various roles, each significant in its own right. To start, we have the settler. This is the person who creates the trust and decides how the assets should be managed and distributed. They're the architect, designing the blueprint for the trust's operation. Next, we have the trustees. They're like the construction workers, building on the blueprint provided by the settler. They manage the trust assets, making decisions in the best interest of the beneficiaries. It's a position of great responsibility and trust. Lastly, we have the beneficiaries. They are the ones who benefit from the trust. They might receive income from the trust, or perhaps they will receive assets when certain conditions are met. Regardless, they are the reason the trust exists in the first place. Each role is crucial for the successful operation of a family trust. But what are the benefits of using a family trust? Family trusts offer a myriad of benefits, from asset protection to tax advantages. Let's delve into this further. Firstly, asset protection. Family trusts can guard your wealth against creditors, lawsuits, and other financial risks. This ensures that your hard-earned assets remain within the family, safe and sound. Then we have estate planning and probate avoidance. Family trusts can streamline the process of passing assets to your chosen beneficiaries, bypassing the often lengthy and costly probate process. This means your loved ones can access their inheritance without unnecessary delay or expense. Lastly, family trusts provide control over the distribution of assets. You can dictate how, when, and to whom your assets are distributed, giving you the peace of mind that your wealth will be managed according to your wishes. But how does one set up a family trust? And what are the considerations to keep in mind? Setting up a family trust requires thoughtful planning and understanding of legal and financial considerations. First off, it's vital to decide the type of trust that best suits your estate planning needs. Is it a testamentary trust that comes into effect after your passing, or an inter vivos trust that starts during your lifetime? Next, consider the legal and financial implications. Seek the advice of a legal expert to ensure the trust aligns with relevant laws and regulations. Also, work with a financial advisor to understand the tax implications and potential benefits. The crux of a successful family trust lies in a well-drafted trust deed. This legal document outlines the terms of the trust and provides a roadmap for the trustees, ensuring your assets are managed and distributed according to your wishes. Remember, setting up a trust isn't a one-size-fits-all approach. It requires careful consideration, planning, and expert guidance. A well-set trust requires an effective trustee. Let's understand the role of trustees in a family trust. Trustees play a pivotal role in managing and distributing the trust assets. They are the gatekeepers, the ones entrusted with the task of ensuring the trust's assets are used appropriately according to the trust deed. Their duties are broad and varied, spanning from investing the trust's assets wisely to distributing income to beneficiaries. Choosing the right trustees is crucial. Some families opt for a trusted family member, while others may prefer the expertise of a professional trustee. It's a decision that cannot be taken lightly, as trustees can be held liable for any mismanagement of the trust. Trustees are also tasked with the management of the trust. They must maintain accurate records, file tax returns, and handle any legal issues that may arise. Their role is multifaceted and requires a keen understanding of both the trust's purpose and the needs of the beneficiaries. Now let's shift our focus to the beneficiaries and understand how they receive their share. The distribution to beneficiaries is a crucial aspect of a family trust. It's a process that requires a strategy, understanding of tax implications, and timing. Let's dive into it. Firstly, the distribution strategy. This could be either distributing income, capital, or both. It's essential to plan this out, considering the beneficiaries' circumstances and needs. Next, the tax implications. The beneficiaries may be liable to pay tax on distributions received, depending on the type of trust and the nature of the distributed assets. It's essential to consider these tax implications when planning distributions to avoid any unpleasant surprises. Finally, timing and discretion. The trustees have the discretion to decide when to distribute the assets. This could be immediately at a particular age or when a certain event occurs. This flexibility allows the trust to adapt to changing circumstances and needs of the beneficiaries. Just as important as setting up a trust is ensuring its compliance with regulatory aspects. Compliance is key when it comes to managing a family trust. One of the most crucial elements is adhering to the reporting requirements. In Canada, family trusts must file a T3 trust income tax and information return each year, even if it has no income to report. This return provides key information about the trust's income, deductions, and tax credits. Along with the annual T3 return, family trusts must also keep track of important tax filing dates. The filing deadline for a trust return is 90 days after the end of the trust's tax year. Documentation is another major component. Trustees must keep detailed records of all transactions, distributions, and decisions related to the trust. This helps ensure transparency and accountability. Lastly, non-compliance can lead to penalties such as fines or even legal action. It's vital to stay current with all regulatory requirements and tax laws. While a family trust offers numerous advantages, it's not devoid of challenges. Family trusts, like any other financial tool, come with their set of challenges. Mismanagement is a common pitfall to be wary of. Poorly managed trusts can lead to financial loss, legal complications, and even broken family relationships. To avoid this, ensure that the trustees are competent, reliable, and understand their responsibilities fully. Disputes among trustees or beneficiaries can also arise, often due to misunderstandings or disagreements over the trust's terms. Open, transparent communication can help mitigate such conflicts. Regular meetings and clear documentation of decisions are good practices to adopt. Tax mistakes are another common challenge. It's easy to overlook certain tax implications, especially when dealing with complex laws and regulations. This can result in penalties or increased tax liabilities. To sidestep this, consider engaging a tax professional who is well-versed in trust taxation. Remember, a well-managed trust is an effective tool, but it requires careful planning and execution. Now, let's understand the recent changes in legislation impacting family trusts. We've covered a lot of ground today. Let's quickly recap. We began with a definition of family trusts and an overview of their various types in Canada, including testamentary trusts and inter vivos trusts. We then explored the key roles within a trust, namely the settlor, trustees, and beneficiaries. We delved into the benefits of using family trusts, such as asset protection, estate planning, probate avoidance, and control over asset distribution. We also highlighted the tax advantages, including income splitting, capital gains planning, and the tax implications for beneficiaries. We discussed the process of setting up a trust, from the legal and financial considerations to the importance of a well-drafted trust deed. We also emphasized the role of trustees, their duties, and the strategies for distributing income and capital. We rounded off with the regulatory aspects, common challenges, and recent legislative changes. Family trusts are a potent financial tool in the right hands. Take the time to understand them, and you'll be well on your way to effective asset management. Having covered the ins and outs of family trusts, it's important to remember that setting up a trust can be a complex process. If you're considering this route, it's crucial to seek professional advice. Here at Charles Shemmy's office, we offer comprehensive consultation services to help you understand and navigate the intricacies of family trusts. Our team of experts can guide you through every step of the process, from the initial planning stage to the final execution, ensuring you make informed decisions that are in your family's best interest. Feel free to reach out to us at Charles Shemmy's office for more information and guidance. Remember, the right advice today can result in substantial benefits for your family's future.